Gold closed today at $5,062 an ounce. 1 year ago, it was $2,936. That is a 72% move in 12 months, the fastest gold rally since 1979. Meanwhile, silver is sitting at $80.46 after falling 34% from its peak. The gold to silver ratio has compressed from over 100 to 1 in April 2025 down to 62.8 today, which puts it right at the lower boundary of the 60 to 70 historical average. Here's why that matters. For the first time in years, neither metal is obviously mispriced relative to the other, which means the decision between gold and silver right now isn't theoretical. It's a real allocation dilemma with real money on the line. There are only 3 types of buyers in this market right now. The strategy that's right for one of them could cost another $1,000s of dollars. And the single most expensive mistake, the one that eats more new buyer money than anything else, is the one nobody warns you about. My name is Alex, and I've spent the last decade tracking precious metals prices, dealer spreads, and central bank buying patterns so you don't have to. If you're building real wealth in physical assets, make sure to hit that subscribe button and give this video a thumbs up if it saves you even one expensive trip to the wrong dealer. Before we dive in, I want to know, do you currently own physical gold, physical silver, both, or neither? Drop it in the comments. I'm genuinely curious where this audience stands. Today I'm going to give you a complete decision framework. Not hype, not fear, not a sales pitch. Just the actual math, the actual costs, and the actual strategy for 3 specific buyer profiles. By the end of this video, you'll know exactly which metal to buy, in what form, and how to avoid the one mistake that silently destroys more new buyer returns than any market crash ever could. And along the way, I'm going to show you the actual cost difference between 2 purchases that look identical on the surface but aren't even close underneath. So, here's the advice you'll hear from almost every precious metals channel on the internet. Just buy gold, or just buy silver. Pick one, stack it, and hold forever. That advice is missing something critical. The right answer depends entirely on 3 variables: your budget, your time horizon, and your purpose. A first-time buyer with $3,000 and a retirement-focused buyer with $200,000 should not be buying the same metal in the same form from the same source. Think of buying precious metals like navigating a toll booth system. Every single road to ownership has a toll. Dealer premiums are the first toll, storage is the second toll, tax treatment is the third toll. Most people fixate on the spot price of the metal and never calculate what the tolls are actually costing them. A buyer who pays 20% in silver coin premiums needs silver to rise 20% just to break even. That's not investing, that's starting in a hole. Let me put real dollars on this. On a $5,000 silver coin purchase at a 20% premium, that's $1,000 gone before the metal moves a single cent. On a $50,000 gold bar purchase at 3%, that's $1,500. The toll system is regressive. It punishes smaller buyers the hardest. And here's the thing, it's not your fault that this system is opaque. Dealers aren't required to show you the premium as a separate line item. Most of them bury it in the total price and hope you never do the math. According to industry dealers spread data tracked through February 2026, gold coins are currently running 3 to 5% over spot, and silver coins are running 15 to 25% over spot. That gap is massive, and it changes the entire calculation depending on what you're buying and how much you're spending. But there's one specific purchase type, marketed heavily to new buyers, where the toll isn't 15 or 20%. It can be 50% or more, and you won't find out until you try to sell. I'll show you exactly what it looks like later. Now we get to the part that actually matters, the 3 buyer profiles and the specific allocation logic for each one. Everything I just told you was the cost structure. What comes next is how to navigate it. And profile number 2 has an insight about the gold to silver ratio that could genuinely change how you think about your entire metals position. The first buyer profile is the first-time buyer with under $5,000. If this is you, silver is probably your entry point, and there's a good reason for that. At $80 an ounce, you can hold over 60 ounces of silver for the same money that buys you less than 1 ounce of gold. That might sound like a superficial distinction, but psychologically it matters more than you think. Holding a tangible stack of metal reinforces the saving behavior. It makes the position feel real. It's easier to dollar cost average into silver over time, buying 5 or 10 ounces a month rather than saving for months to afford a single gold coin. And if you ever need to sell a partial position, silver gives you that flexibility in a way that a single gold coin simply cannot. But here's the thing. This is exactly where the toll booth bites the hardest. Silver American Eagles, the most recognized silver coin in the world, currently carry premiums of 20 to 25% over spot. So that $80 spot price turns into $96 to $100 per coin at the register. However, a 10-ounce silver bar from a reputable private mint carries roughly 8 to 12% premium. On a $3,000 purchase, that difference is somewhere between $240 and $390. That's real money. Coins offer recognizability and slightly better liquidity when you resell. Bars offer a significantly lower entry cost. For a first-time buyer under $5,000, the math leans toward bars or generic rounds from recognized private mints, unless you specifically want the government-stamped liquidity premium and you're willing to pay for it. Just make sure that choice is conscious, not accidental. The common mistake for this profile is buying from television ads, or those so-called collectible sets that come in velvet boxes with certificates of authenticity. Congratulations, you just paid a 50% premium for a coin with a pretty case and a piece of paper that's worth exactly $0 at any coin shop in America. But hold on, I'm going to break that scam down properly in a few minutes. First, let me show you why profile number 2 might actually have the most interesting opportunity in this entire market. The second buyer profile is the existing gold holder looking to add exposure. If you already own gold, the February 2026 data should make your ears perk up. The gold to silver ratio at 62.8 means it takes about 63 ounces of silver to buy 1 ounce of gold. In April 2025, that ratio was above 100 to 1. Historically, the ratio oscillates in a range, and when it gets extreme in either direction, it tends to revert toward the mean. If mean reversion occurs and the ratio drops further, say to 50 to 1 or even 40 to 1, silver outperforms gold on a percentage basis even if both metals rise. Let me make that concrete. If gold goes from 5,062 to 6,000, that's about an 18% gain. If silver goes from $80 to $120 during the same period, which would represent a ratio compression to 50 to 1, that's a 49% gain. Same bull market. Dramatically different returns. So for existing gold holders, allocating new capital to silver right now is a ratio trade, a bet that the historical relationship between these two metals continues to oscillate. If you've made it this far, you're already ahead of 90% of people researching metals online. But don't stop now, because the next profile is where the real long-term money gets made or lost, and the storage and tax section after that could save you thousands. The common mistake for this profile is going all in on the ratio trade and abandoning gold entirely. The ratio is a tendency, not a law. It can stay elevated or compressed for years. A reasonable approach is allocating 25 to 40% of new metals purchases to silver while maintaining your gold core. Treat it as a tilt, not a revolution. The third buyer profile is the retirement-focused buyer. If your time horizon is 10 years or longer and your purpose is wealth preservation, gold is the more defensible hold. Not because silver is bad, but because gold has structural advantages that compound over long periods. Central banks bought over 1,000 tons of gold in both 2023 and 2024. That buying hasn't slowed in 2025 or 2026. When the institutions responsible for backing entire currencies are choosing gold, that tells you something about where they see long-term stability. Wells Fargo published a year-end 2026 gold target of $6,100 to $6,300 per ounce. That represents another 20 to 24% upside from today's price. And that's the conservative institutional estimate. Gold's lower volatility profile also means fewer stomach-churning drawdowns. Silver just demonstrated this, falling 34% from its peak. Gold, during that same period, pulled back less than 8%. If you're drawing on these assets in retirement, that volatility difference matters enormously. You don't want to be selling silver at a 30% drawdown because you need the cash for a medical bill. The allocation logic here is straightforward. For retirement-focused buyers, 70 to 80% gold, 20 to 30% silver. Buy gold in 1-ounce coins or bars from sovereign mints where premiums run 3 to 5%. The premium is worth it because sovereign minted gold, think American Gold Eagles or Canadian Gold Maple Leafs, carries instant global recognizability. For buyers placing orders above $50,000, bulk discounts start applying, sometimes shaving 1 to 2 percentage points off premiums. That's not nothing. On a $100,000 purchase, that's $1,000 to $2,000 saved. Now let me address storage, because this is the toll most people don't think about until it's too late. You have three basic options. First, a home safe. Lowest ongoing cost, full immediate access, but you're carrying the insurance burden and the security risk yourself. A quality bolted safe runs $500 to $1,500 and should be rated at least TL15 for any serious metals position. Second, a bank safe deposit box. Moderate cost, usually $75 to $300 a year depending on size. But here's what most people don't realize. The contents of a safe deposit box are not covered by FDIC insurance. If something happens to those contents, you're on your own unless you carry a separate insurance rider, and you cannot take a tax deduction for metals stored in a bank box. Third, an IRS-approved depository. This is the option for anyone holding metals inside a self-directed IRA. The metals must be stored at an approved facility. You cannot touch them, you cannot store them at home, and the depository charges annual storage fees, typically 1/2 to 1% of the value. The upside is tax-deferred or tax-free growth depending on your IRA type. The downside is fees that compound and access restrictions that can frustrate people who like the tangibility of physical metals. Each storage option has a different tax implication. Metals held personally and sold at a profit are taxed as collectibles at up to 28% federally. Metals inside a traditional IRA are taxed as ordinary income upon withdrawal. Metals inside a Roth IRA grow and distribute tax-free, assuming you meet the holding requirements. The difference between 28% collectibles tax and 0% Roth tax on a $100,000 gain is $28,000. That's not a rounding error, that's a car. The real magic happens in your brain, because here's a hard truth that might sting a little. The reason most new precious metals buyers lose money has nothing to do with the metals market. It has to do with psychology. Specifically, it has to do with the gap between how metals are marketed and how they actually trade. Now let me close the loop on that expensive mistake I've been teasing since the beginning. It's called the numismatic premium trap, and it works like this. A dealer or television marketer sells you a coin that's described as rare, limited edition, or collectible. The coin contains 1 ounce of gold, same as any other 1 ounce gold coin. But instead of paying $5,200, which would be the spot price, plus a normal 5% premium, you pay $7,000 or $8,000 or even $10,000. The extra money is supposedly for the coin's numismatic or collectible value. Here's the problem. When you go to sell that coin, every dealer in America will offer you spot price plus maybe a few percent. Nobody is paying a numismatic premium on a modern mass-produced coin. That is the trap. You paid an extra $2,000 to $5,000 for a story, a certificate, and a fancy box. The gold inside is worth exactly what every other ounce of gold is worth. This is the single most expensive new buyer mistake in the precious metals market, and it happens because the marketing is sophisticated and the buyer is emotional. The coins are often marketed during periods of fear, exactly when people are most vulnerable to urgency-based selling. I know this isn't what you want to hear if you've already made this purchase. But if you haven't, I just saved you potentially thousands of dollars. The deeper pattern here is about identity. Are you a metals investor or are you a metals collector? Investors optimize for lowest premiums, efficient storage, and tax-advantaged structures. Collectors optimize for beauty, rarity, and display value. Both are valid. But confusing one for the other is where the damage happens. The marketer's entire strategy depends on you believing you're investing when you're actually collecting. Once you see that distinction, the whole market becomes clearer. Now let me tie all of this together, because when you see how these three profiles, the cost structure, and the storage options connect, the entire decision simplifies dramatically. If you're a first-time buyer under $5,000, buy silver bars or rounds from reputable private mints, store them in a home safe, and accept that your premiums will be higher than you'd like but manageable in the 8 to 12% range. Avoid coins with premiums above 15% unless you specifically want sovereign minted liquidity. If you're an existing gold holder adding exposure, tilt 25 to 40% of new purchases towards silver to play the ratio compression. Buy silver in 10-ounce or 100-ounce bars where premiums are lowest. Reassess the ratio quarterly. If you're a retirement-focused buyer, anchor in gold at 70 to 80% of your metals allocation. Consider a self-directed Roth IRA with an approved depository if the tax math works. Wells Fargo's 6100 to 6300 target gives you institutional validation, but don't buy based on a single price target. Buy based on the structural case, central bank accumulation, dollar diversification, and inflation hedging over decades. And regardless of which profile you are, never pay a collectible premium on a modern mass-produced coin. Never store IRA metals at home. And always calculate total cost of ownership. That means spot price plus premium plus storage plus tax treatment before you buy a single ounce. Remember that toll booth system I described at the beginning? You're not stuck paying the highest toll anymore. You've seen the map. You know which roads are expensive and which ones aren't. You know that the toll punishes small buyers hardest, that coins cost more than bars, that storage and taxes are hidden costs that most people ignore, and that the most expensive road of all is the one paved with numismatic marketing. Your future self, the one who's sitting on a metals position that's grown for a decade or two, is counting on you to make the smart entry right now. Not the emotional entry, not the fear-based entry. The calculated one. Gold, silver, premiums, storage, the gold to silver ratio, taxes. What's the next topic you want me to dig into? What question is sitting in your head right now that I didn't answer? Drop it in the comments. That's exactly what this channel is for. The spot price is just the beginning of the conversation. What you do with the information after that is what separates people who own metals from people who profit from them.